Did you know that the foundations of modern financial markets were shaped by a few groundbreaking theories that continue to drive our financial systems today? Imagine a time when economic decisions were guided purely by intuition. Fast forward to now, and those decisions are grounded in complex models. Welcome to Factful Finance, where today we're diving into the evolution of financial economics and the key theories that have transformed the way we understand markets. This is Financial Economics, Part 4. Let's rewind. Picture this. In the early 20th century, finance was mostly speculative. Investors relied on gut feelings, and markets weren't as structured. But then, along came a wave of theories that revolutionized everything. First up, the efficient market hypothesis, EMH, a theory that argues that asset prices fully reflect all available information. Think about it. The stock market isn't just random chaos. It's an intricate reflection of all known data, from economic reports to corporate earnings. The implications? If markets are efficient, trying to outsmart them is nearly impossible. But as markets evolve, we're starting to question just how efficient they really are, especially with the rise of behavioral economics. Enter behavioral economics, a game changer that challenges the traditional notion of rational decision-making. Nobel laureate Daniel Kahneman's work introduced us to the idea that we don't always make rational choices. In fact, cognitive biases like loss aversion and overconfidence often lead us to make poor financial decisions. Remember when you held onto a stock for too long thinking it would bounce back, only to watch it drop even further? Yeah, that's behavioral economics at play. Now, no story of financial economics would be complete without mentioning modern portfolio theory, MPT. Developed by Harry Markowitz in the 1950s, MPT introduced the concept of diversification, reducing risk by holding a mix of assets. It's the reason you're advised not to put all your eggs in one basket. MPT says balance is key. You should have a mix of stocks, bonds, and other investments to protect your overall wealth from market volatility. But what happens when markets don't behave as expected? Enter the capital asset pricing model, which builds on MPT by helping us understand the relationship between expected returns and risk. Essentially, CAPM tells you how much return you should expect based on the risk of an investment. And it even introduced the concept of the beta, a measure of how much an asset's price moves in relation to the overall market. As we step into the more complex territory, let's talk about arbitrage pricing theory, APT, which expands on TACM by accounting for multiple factors that could affect an asset's return. While CAPM focuses on one, APT says, hey, we need to consider things like inflation, interest rates, and more. And finally, we can't forget market microstructure theory, which looks at how securities are traded and how that affects pricing and liquidity. You know those times when it feels like there's a delay in a stock price moving, or an unexpected jump happens out of nowhere? Market microstructure explains why. These theories didn't just change the way we think about markets, they altered the landscape of financial economics itself. But here's the kicker. Financial theories are evolving all the time, and as we introduce newer models, we keep discovering better ways to optimize investments, manage risks, and enhance portfolio performance. Ever wonder how these theories apply to real-life scenarios? Let's look at Emma, who used MPT to build a diversified portfolio. After diversifying across various asset classes, she saw a significant reduction in the volatility of her returns, and her risk-adjusted returns improved dramatically. Or think of Liam, who implemented TM to evaluate his investments in tech stocks. By factoring in the beta, he managed to accurately assess the risk and understand how much return he should expect for that specific risk level. These theories guide the way investors like you manage risk and maximize returns. So, whether you're a beginner or an experienced investor, understanding these concepts is key to making smarter financial decisions. Want to level up your investment game? Keep diving into financial economics. It's one of the best ways to stay ahead of the market. But before we go, let me ask you, what theory or concept from today's video stood out to you? Drop your thoughts in the comments. I'd love to hear from you. Remember, this content is for educational purposes only. Mentioning any products or services is not an endorsement. Always consult a certified financial professional for personalized guidance. If you found this helpful, you're going to love what's coming next. Click the video on screen now to keep expanding your financial knowledge.